Right now, I'm using a risk structure that allows me to profit most of the time, even if I screw up the entries multiple times, and even if I'm wrong multiple times in a row, and even if the timing's bad and everything. I only take trades where there's a risk structure where I think the ending outcome is likely to come out in profit. It is essentially, it's like a hybrid between dollar cost averaging, which people just call DCA. It's a hybrid between DCA, recovery trading, which is just adding to losing trades the next area you think it's going to bounce at, and then grid trading, which is just, grid is like every 5 pips you add, every 10 pips you add, every 50 pips you add. And then also, like, I hesitate to use this word because people just rip this apart, but the word is up.
All right, folks, here we are on Trading Up. We've got a familiar face in the house. He's been on the show about 4 times already in the past. It's Nick Shawn. I've been following a lot of what he's been doing recently because he has, I suppose, a lot of the philosophies behind what he's done with his trading is sort of where I've landed, ironically, through a whole bunch of things that I've just been doing in the last four or 5 months. So welcome back to the show, Nick.
Cam, it's been 7 years since we did our first episode. It's crazy that it's now all this time has passed. I think this is my 4th pod, so thanks for the welcome.
Yeah. I feel like I'm kind of like a little bit low here on the, let me just bring that down, get our bald heads just at the right height. There's a couple of eggs in a basket, right? So, look, do you want to give the listeners a bit of a background into like what you've been up to over the last sort of? I suppose it's probably been about 9 months since you're on, before maybe a year. So let's an overview of that, and we'll dive into some of the things I want to ask questions around.
Absolutely, yeah. So it's been over 2 years since our last episode. It was
wow.
It was like maybe almost midway through 2022. So been some time. We're at the end of 2024 now, so maybe 2.5 years or so. What I've been up to is I've just continuing to been growing as a person and a trader. So like my trading approach, the method that I use to trade, the risk structures I use, they've all kind of evolved with time, and it's caused me to, I've wound up here like 8.5 years after my journey started, doing almost nothing when I trade now. It's really, really weird. And it's like, there's been so many things I've tried over the years. There's been so many things I've done, all of them working more or less to some degree. But nothing's really worked as well as what's been working for the past 2 years for me. So I'm sure we'll get into more details about that. But that's what I've been doing. That's what I've been up to.
Okay. And so you basically, I mean, you are probably one of the most transparent traders on the internet in terms of like, you know, everyone gets to see everything you're doing, either be it in your Telegram, which is free, or your own other private stuff. What are you actually doing? What's the style you'd sort of give to your trading at the moment?
Yeah, I can sum it up with just 2 simple steps, essentially. It's all based on experience. It's all based on intuition. There's no strategy. There's no, buy when the moving averages cross with a 1 to 3 risk reward ratio. It's nothing like that. Here's the 2 steps. So the first thing is I just look at a chart and ask myself, do I think it's going to go up or down? And there's only like 1 of 3 answers. Like, I think it's going to go up, I think it's going to go down, or I don't know. It's that third thing most of the time. Like, I don't know. Like 99% of the time it's like, I don't know. So I don't take a trade. If I do, in fact, think price is going to go up or down based on reasons that are outside the realm of what most people call strategy, then the second thing that I come to, the second portion of this is like, okay, let's say, for example, I think it's going to go up. Why? Just my intuition, my experience. I just look at a chart. I'm like, looks like it's going up. It's kind of pulled back. It's starting to kind of twist around. It just feels like it's going to go up based on my experience. So I'll say, all right, I want to buy. Then I move to the second part, which is like, okay, now how do I control risk? Right now, I'm using a risk structure that allows me to profit most of the time, even if I screw up the entries multiple times, and even if I'm wrong multiple times in a row, and even if the timing's bad and everything. I only take trades where there's a risk structure where I think the ending outcome is likely to come out in profit. It is essentially, it's like a hybrid between dollar cost averaging, which people just call DCA. So it's a hybrid between DCA, recovery trading, which is just adding to losing trades the next areas you think it's going to bounce at. And then grid trading, which is just, grid is like every 5 pips you add, every 10 pips you add, every 50 pips you add. That's grid. And then also, like, I hesitate to use this word because people just rip this apart, but the word is martingale. It is a,
you're going to say that.
Yeah. So it's like a pseudo DCA recovery trade grid martingale approach. Now, it's not like I'm doubling my bets every single time I add. I don't do that. They're generally just the same bets. They're sized very small. For example, my average position size right now for starting a trade on a $200,000 account with a regulated broker, Forex.com, with low leverage. My lot size on a $200,000 account on average is anywhere from 1 to 2 lots to start a position. So I'm barely using any sizing, right? But most of the ideas are based on the higher time frame, so you catch more movement, and that's what results in the profit. All the while having very low swap fees because the sizing is so small, never getting close to your margin requirements, and then on top of that, still being able to generate a decent profit. For example, like last month in my group, I call my trades live. That's like the only subscription product I sell now. I just call all my trades. I did a 14% gain on the 200K account. It was $30,000 in profit. It went from like 165 to 195K. And then the max drawdown during that time period was only like just under $5,000. So just under $5,000 peak drawdown while making a 30K profit in a month. And this month we're up as well. The whole way this works is literally just a lot of it's just my experience, just because like a new trader doesn't know like what exactly is going to be the case whenever they're entering and exiting trades. But it's essentially just looking at a chart saying, I'm going to buy or sell here, and then I'm going to control risk using the risk structure that I just very briefly discussed that we can get into later in this video. But that's all I'm doing. I'm buying when I think it's going to go up, and I'm selling when I think it's going to go down. And I'm using DCA as a risk structure to be able to usually come out on top, even if I'm wrong multiple times in a row in a trade that just keeps going against me.
Now, if you're loving the show and thinking, where can I go and trade? Why don't you check out my prop firm sponsor, Blue Guardian. Now, these guys have been around for ages. They've been sponsoring Trading Up for over a year. And some of the key features that make them so good is that they've got realistic profit targets for their challenge phases. It's only 8 or 4%. They also have a scaling plan up to $2 million, and they do profit splits of 85%, which is really high for this industry. They also have quick and reliable payouts and a robust reserve that make sure those payouts are as seamless and smooth as possible. Now, if you're looking to join, go and check them out. But first, grab my coupon code TradingNut, all one word. You're going to save yourself 25% off at checkout. There's a link in the description. Go and click that now. Right, let's get back on with the show.
Okay, well, look, later on we might dive into a chart and just sort of see what that looks like on a chart point of view. But it's quite interesting you say that, because just in the past 12 months, I've kind of have met a number of different traders. And as people know, I meet traders all the time, right? So, but I've met a lot of them that it seems that the ones that are most profitable, and I've had that even verified by third party, so I won't say, but that most profitable and even some of the best traders within organizations are using this kind of approach. So this dollar cost average / martingale, not necessarily martingale, but like, definitely grid, definitely not using a stop loss and sort of entering into losing positions, tend to be the ones that are actually doing really well and growing accounts and getting out with profit. Yeah, they might falter now and again, but in general, they tend to be the ones that can grow an account for the longest period of time without I suppose, having a dramatic sort of losing streak, which kind of just sets them back. Now, you talk about like the lack of a strategy here, and this is something I've kind of fallen into myself, which is like, I've tried every strategy under the sun, right? And they all work for a little period of time, and then they kind of just start falling apart. Now, could be me, could be something else, but I look back and go, well, that day or that month, this thing absolutely got hammered. And for me to try and come back from that is going to be like really, really hard. So what's your thoughts on people who are sort of focused on that, let's call it a holy grail kind of strategy that's going to work forever, and never sort of trust their intuition at all?
Yeah, here's my thoughts on it. First, let's just pay homage and let's just validate people who think that, yeah, if you just put a strategy together and you've tested it and it has a good win rate and risk reward, the stats, then it's going to work long term and you'll be able to make tons of money, and all you have to do is just follow the strategy. It couldn't be more simple. It sounds so good. And like people like you and me, like we used to believe this, right? Because it just sounds logical. Like we've tested it, we've done this, and everything makes sense. It's going to make money. The problem is, and the nuance that's not captured in that belief is the fact that the main thing that is going to make you profitable in manual trading, like as a human making trading decisions, that's not an algorithm. The main thing that's going to make you profitable is your ability to have like a sort of quality control mechanism in your brain to parse which trades are worth taking based on the quote strategy. A strategy is kind of just like a story and a narrative that a trader tells themselves about why they think price is going to do what they said it's going to do. And then, but what really matters is a trader being able to use their discretion and intuition, that little subjective judgment about like, okay, yes, this quote fits with the strategy, but something doesn't seem right here. I've been doing this for like a year and I've noticed that this doesn't really work this well in this context. And I can't quite put it into words and I can't put my finger on exactly what it is, but I don't think this is a good trade to take, even though it meets the criteria for the quote unquote strategy. What I've found is intuition and discretion that someone gets from experience of trading and just seeing the same things happen over and over for years. That's really the only thing that dictates whether or not someone is profitable. You can make a whole list of things, profitable versus non-profitable, and what makes someone profitable. But that right there is the top of the list, your ability to sort of instinctively, intuitively decide what to do and what the best decision is based on the given context you have. So since you're going to have to use intuition, discretion anyway, the way it works, a lot of people, they'll look at it, they'll say, here's your strategy here, and then you parse it through intuition to decide what to do, and the result is either you're profitable or not profitable. What I do is I just like cut out this strategy part over here, because if you're going to have to pass it through intuition anyway, you can just start with intuition. Now, instead of having a strategy, then you have to use your intuition to pick which trades are good and which aren't, and then that gets you profitable. You just remove the strategy altogether and instead just use your intuition. Like if you have enough experience looking at charts and you have enough experience like controlling risk and practicing the method that you're going to go about doing these things, you can just look at a chart and you can say, do I think it's going to go up or down? And you don't even have to have a real reason. The whole reason can just be, well, I've just been trading for years and this just looks like it's going to go up and down. You may not be able to articulate it. You may not be able to communicate it to someone else. You might not be able to put it into words. You might not even know why most of the time, but intuition is one of these things that has evolved in humans to help us survive. This just manifests itself in like making trading decisions that are probably not going to make you lose all your trading capital and probably give you the chance to make a profit long term. And it's weird whenever people look at other things in life, like say, for example, riding a bike. I give this analogy all the time. You and I could go to a college level class there in New Zealand, and we could learn how to ride a bike and do a whole semester, 6 months of learning how to ride a bike. They got a whiteboard and everything. They've got all these workbooks we go through. But really, the best way to learn how to ride a bike is just to get outside, maybe get some training wheels on it or someone there to make sure you don't fall. And you just get on the bike and you start learning how to ride, and you learn through experience. You won't be able to put into words like, I'll say, why did you turn the handlebar 15 degrees to the right and then lean at a 48-degree angle when you're like, you won't really know. You'll be like, I didn't even know I was doing that, but you can hold yourself up on the bike and you can still ride and you can still do it successfully. You only get that with experience. And this is true with every single skill set in life. The problem is when people come to trading, they try to overlay this rationality, sort of scientific, empirical, evidence-based methodology to try to make things work in a black and white absolute way. Whereas trading it's not quite a science. Like maybe there's some things you can do black and white. Like you can say, I'm going to risk this much per trade. You can define that, sure. But a lot of things in trading, it's more so an art, not just a science. It's mainly, I think, a large percentage an art in terms that it's just a skill set you have to learn with time. And the more experience you get, that informs your intuition. Your intuition deforms the actions and decisions that you make, and those decisions result in you either being profitable or not profitable. So those are my thoughts on the use of intuition in trading.
Interesting, because so within the last 5 months, I've done a number of different things, right, and tried different strategies that either I've come up with or somebody's taught me, and I've gone through and right, let's trade the strategy and see how we go. I've also did just off the, I think it might have been even off the back of listening to something you'd done, and I was like, right, I'm just going to trade what I'm going to call intuition, which is essentially all my market knowledge based on number of different strategies that I've got floating around in my head, which kind of I can see when is a good time to enter and when I should be taking a trade. A lot of the time I don't, or I didn't in the past, because I was like, it doesn't meet my strategy, so I'm not going to take that trade, or it goes against this strategy, which I know that I'm trading, so I'm not going to take it, even though my intuition tells me this is the better trade. So I ended up doing that, and I actually doubled. It was the first time I doubled an account like ever, and I was like, damn, this thing actually worked. And I had weeks where I was profitable. I'd have always struggled to get a multiple back-to-back week profitable weeks in a row. And in this case, I think I did like 4 weeks, bang, 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 double the account. I think it was like 17 trading days. So it was purely based on, I see something, it meets with a lot of the things that I know, and I want to get in. I'm going to put my stop. I was using stop loss on all of these trades. The risk, management was tight, and I was growing these accounts. Hey, I wasn't getting like 5-6 hour trades every day. In fact, I think I might not have got any. I might have even got like one runner that went 4 hour or something. But it was half an hour, 0.75, 0.25, small loss, break even, 1 hour, 1.5, that kind of thing. So it wasn't even like huge wins and stuff. It was just solid intuition-based trading where I felt that this thing was going to do this, and most of the time I was right. And then it's going to stop here, so I'm going to get out of that trade instead of holding on to it and hoping that something's going to happen. I'm just going to get out because it just doesn't look right, and that's all based on intuition.
Hey folks, what a view behind me. I'm at Black Bull Markets headquarters here in Auckland, New Zealand. Speaking of views, you can get TradingView paid plans for free at Black Bull Markets, saving you up to $600 a year. That's right, get either the Essential, Plus or Premium plans absolutely free, and all you need to do is trade from one lot a month at Black Bull Markets. And you can also get a 100% deposit bonus for your first deposit up to $1,000. All you need to do is click the Trading Nut link in the description below.
For somebody out there who's like delved into a strategy and they're like, right, I've got this mentor, they're teaching me the strategy. How do they bring in their intuition into what they're doing? What are your sort of bits of advice around that?
Get some experience trading. That's the advice. Thanks for the podcast, Cam. So, yeah, well, to break this down a little, let's first put a little bit of a boundary around what I'm saying here. The way that I trade, I want it to be clear. The account will eventually blow. Now, that's the cold, hard truth. And most people, they hear this, they immediately run the other way. They tried to learn smart money, institutional order block, liquidity, Kobe steak, Wagyu beef, bullish distribution, candlestick strategies with the 1 to 50 risk to reward ratio. And they go through all this stuff, and they don't like hearing that, okay, this guy's trading with something that he just self-admittedly says is going to blow the account someday. The problem is most people don't stay long enough to hear the second part, which is that most of the time the account's not going to blow. If you're trading with small position sizing, and then you're adding to losing trades at areas where you think they're likely to bounce, and you're using relatively higher time frames, anywhere from I'm talking like H4 to daily to weekly, most of the time you're going to have most outcomes end in profit, and it's not going to blow your account, and you'll be able to get the account to a growth target. For example, doubling the account, just like you did. And every time you get it to the growth target, you just withdraw. So let's say, for example, that like 75% of the time you're going to be able to grow an account to the growth target. In a very oversimplified example here, we could say you have 4 accounts, and then 3 of them grow. Each of them were $1,000 starting balances. So you doubled them. So you made $3,000 profit. But then the 4th one you blow. So you lose $1,000. But you're still up $2,000. And then also you completely remove the mental gymnastics and the obsession between having to be right and worried if you're following your strategy and going on a losing streak. Because with this trading approach, there's really no losing streaks in the sense that like you're not having multiple stop outs in a row, because the system does not use stop losses. It uses DCA as the risk structure. So you just add the losing trades at the next area, with the idea that, okay, eventually 99% of the time it's going to bounce somewhere. And as long as you're sizing small enough, the account usually isn't going to blow. But every now and then it will blow, and that's okay. You just have to keep withdrawing every time you get the account to a growth target, like doubling it. So you double it, withdraw, double it, withdraw, double it, withdraw. Then when you blow the account, you're not losing all the profits. That's the only thing that makes this approach profitable. You can't just do this for years and years with the same account, because eventually you're going to blow the account and you will have protected no profits. Like, it won't work in that sense. So that's the first framework I have to put it around. Like, I would do it in that way. So with that being said, let's say a trader wants to build experience. This was the whole point of your question, is like, how does someone get that experience if they don't have it? Well, say somebody has, I'm just making up numbers here, $10,000 to trade with. So they ask themselves, how much am I comfortable blowing? Like, if I put into an account trying to grow the account, what am I comfortable with completely losing? Because the account effectively functions as your stop loss. So let's say that a trader says, I'm comfortable risking $2,000 of my $10,000. Well, they keep $8,000 in their bank or like a little master account with their brokerage account. They don't trade. They start a sub account. They put $2K into it. So now you get $2,000. The way I suggest people get experience, and I'll say this just as a general disclaimer. I know you already have it on your website. This is not financial advice. I'm just some random guy who trades. I'm not a financial advisor. Be very careful because trading is risky and people do in fact lose money. And this is all just my opinion. So I'm of the opinion that if a trader starts, say, a $2,000 account and they just use a 0.01 lot size for every trade they take, you can trade all the FX majors and minors. It's like 24 to 26 pairs, depending on which broker you're with. If you use a 0.01 lot size for every $2,000 you have in an account, what that means is two things. Number one, you're very unlikely to blow it. Number two, you're very likely to come out most outcomes in a profit. So if you're trading like, say, like the 4 hour or daily, you're marking up all the zones, price goes up to here and you sell, and then price goes up against you, then you sell again with another 0.01 lot, and then it goes up against you and sell with another 0.01 lot. When it finally bounces, even if you've added 2, 3, 4, 5 times, number one, you're probably not going to blow the account when it goes into drawdown. But number two, when it turns back around and goes into profit, you're going to end the outcome in either a break even or a profitable outcome, depending on exactly where you close. The point of doing this is not to make money, because you're not really going to make a lot of money using 0.01 standard lots, like micro lots, and that's fine. The whole goal of doing this is, one, protecting capital. So just partitioning a small amount of your capital in one account, keeping most of it in cash in your bank account or whatever. So you don't have much capital at risk. But number two, you're building experience in a very low risk way. You're building experience in the way that allows you to start seeing how outcomes play out. So that way, if you know, okay, the average time it takes you to, say, double an account, let's say it's like 4 months, right? Just for example, making up numbers. 4 months to double an account. And let's say the maximum drawdown at any given time you reach during that 4-month period was like a 20% drawdown. Well, you could be having these accounts and they're in like, you have a 20% drawdown. That was the worst case scenario, but you did 100% growth over that monthly period. For you, it was like, about like 3 weeks, a little under 3 weeks for you where you doubled an account. So you can do this. That builds experience. And then it also teaches you, okay, there are certain trading opportunities that tend to work better than others. And you won't be able to explain why, but you'll be able to start finding trades where you're like, okay, price has made a higher high and it's at a weekly zone and it's already had a little bit of bearish sensitivity on the weekly closure. This looks like a trade that's really likely to work. So instead of using 0.01, you can then make the discretionary decision to say, I'm going to use a 0.02 lot size, or whatever you want. And then you recognize it'll be more risk, but your skill set and your proficiency in trading is really what dictates the risk in trading. There's obviously market risk because nothing's 100%, but the more skilled you get, the slightly lower risk that trading comes in terms of like predicting where you think price will go. And if you can barely predict where it goes a little more than half the time, even if you're just using stop losses and you're not using like a DCA structure like you and me, where you can come out of most trades in profit, even if you're just using stop losses, if your win rate's above 50%, long term, you can make money. When you then combine that kind of win rate, which say it's like 60%, with something like DCA, where you know that if it doesn't bounce here and you're not right the first time, it can go against you, then you can add. And then if that goes into profit, you can close the whole basket of trades in a net profit. You end up coming out of like, a high percentage of outcomes, like 90% or more, with either a break even or a profitable scenario. And meanwhile, you still recognize every now and then there's going to be drawdowns. Every now and then you're going to have something continues to go against you. You're waiting to add. It's in the deep red. You're waiting for it. Then you add. And then finally it turns around. You close everything at a break even and it's all fine. And then also you have tons of trades. Like half of your trades, the moment you enter, they're just going to start going into profit. Like that's 50% of trades, because price either goes up or down. You could just flip a coin and enter randomly, and then half the time it's going to go into profit and half the time it's going to go into loss. So half your trades you're just ending very relatively quickly because they just go directly into profit. It doesn't take much management. The other ones, you can manage them by that risk structure. So this is the way that I would go about getting experience if I were in a position where I wanted to get experience learning trading. Just start like a small account, use like a 0.01 lot size for every $2,000 in the account. If you're not comfortable risking $2,000 or you don't have $2,000, then just use a demo account with $2,000 and do same lot sizing, 0.01. Take any and every trading opportunity you want and just use that as a way to build experience. It's not going to be the way you trade for the rest of your life, but it gives you a starting point where two things are true. You're very unlikely to blow the account, and also you are very likely to come out in most outcomes in profit. and then all of this helps you build experience. You should do this for at least 6 to 12 months minimum. Then you get all that very valuable experience so that then in the future, you can start making more pinpointed trading decisions and waiting for, quote, better entries that you think are more likely to work. And you can start sizing up the risk a little bit like you've done. And all these things can come together if you just start by doing this very simple thing that I've just described.
It's interesting. It just reminded me that I lied before, because I actually had a 3-month period where I did have back-to-back winning months, and doing something with it was a dollar cost average strategy, ironically. And yeah, that was the thing that got me, it was no stop loss. It was almost exactly what you're talking about. And it did get me 3 months back-to-back profitable months, which now I look back, I'm like going, okay, well, why did I not sort of see that as significant back then? And I sort of moved on from it and just discarded it at one point. Now, what about a mindset thing for anyone sort of, because that reminded me of the mindset thing that you had to go through, obviously, which is quite different from what most people are probably, I'm guessing, doing when they've got this strategy approach and they've got like a fix, a 20 pip stop, and, I'm looking for a 1 or 2 or 3 hour or whatever it is. What kind of mindset shift do people have to make in terms of this, and is it difficult?
When mindset shift, like, think about it this way, like, you're not really putting much risk on the line. The only thing you're really risking is your time, right? And then maybe like $2,000. But again, if you don't have $2,000, it's okay. Just start a demo account. Now there's no monetary risk whatsoever. The only thing you're really risking is your time. And if it's worth it to you to spend, say, like the next year trying to learn trading, and you're comfortable saying like, okay, I can get to the end of this year and it doesn't work and I could just decide to quit then I've, quote, wasted a year of my life trying to learn how to trade, then you can move on. If you're cool with that, like, that's the only real risk. By understanding what the risk is, it puts your brain in a position where your brain does not fear the danger. Like, you just start saying, you're like, okay, yeah, I'm going to get into these trades. And if I add and they start going against me, like, the account's either going to blow, which I already knew to begin with at some point that would happen. So then you've already accepted that risk. Or most of the time it's going to come back and the trades will end in like a huge profit or a break even. Usually worst case scenario, it's break even most of the time. By understanding that there's really not much risk if you approach it in the exact specific way that I have just outlined, then your brain doesn't start fearing the outcomes and you get less attached emotionally to the outcomes. And then it allows you to do things in such a way where you are sort of free of the paralysis of risk. And risk is really the thing that causes you to, quote, make stupid emotional decisions in trading and FOMO trading and then revenge trading and all this stuff that people talk about. The psychological aspect and the mindset aspect is not really difficult, provided that you've structured the circumstances and the conditions properly. And that is just, you just have to be obsessively meticulous about how you define the risk. If you define the risk and you accept the risk, then there's not really much mentally you have to worry about. And so you can just start making decisions very carefree in a way that's real conducive to creativity and problem solving and thinking in such a way that you are truly like flexible and resilient, and you're not like worried about, like, you're not checking your phone 5 times every hour looking at, that's a weekly chart, the weekly candle move 5 pips down. You just won't be doing that type of stuff because you've already structured the risk and you already know what the outcome is going to be. It's not this thing that's all up in the air. You're like, the next trades could win. I could go on a losing streak this week or a win streak this week. You already kind of know what the outcomes are likely going to be. So then that completely removes like the mindset aspect that most people have to struggle through their whole trading career.
Yeah, it's I did meet a trader this year who he'd learned from somebody whose whole sort of I suppose philosophy around trading was, don't have a stop loss, because if you have a stop loss, you've already told yourself that there's a chance you're going to lose the trade. And therefore that's playing with your, I suppose, internal sort of biases or whatever they are, to then potentially make trading a heap harder than it should be. So there is some kind of, I suppose, inverse mindset thing or whatever trading psychology thing that works on you when you don't have that stop loss and accept that risk, which Nick's just been talking about. So Nick, why don't we dive into a chart and just have a look at one of these sort of trade examples of like something that somebody could do if they were like jumping on your Telegram and sort of seeing these trade opportunities come up. What could they do from a if we jump in a price chart and have a look, how would they play out a trade?
Yeah, Yeah, I'll show you like everything I do. I'll just teach you everything. Here we are in a chart. You can see the only things I really have right now are just the daily and weekly charts. So what are we doing? Let's completely just remove all the price candles and I'll show you. Price just goes up and down. If you think price is going to go up, then buy. And if you think it's going to go down, then you sell. Don't worry about the narrative. Don't worry about the reasons. You don't even need to worry about things like I'm buying because it's at a support zone, or I'm selling because it's at a resistance zone, or the Fibonacci, it's pulled back 61.8%. Don't worry about any of the technical details. Look at the chart and just decide if you think it's going to go up or down. And if you really have no idea, flip a coin. I know that sounds ridiculous, but again, keep in mind you're just trying to build experience. If you don't know which way price is going to go, or you're not confident enough that you want to take a trade on it, just flip a coin and enter like heads buy, tails sell, and do that with a 0.01 lot size on either a $2,000 demo account or a $2,000 live account if you're comfortable losing $2,000. So let's say, for example, I think price is going to go down. Why? I don't know. My experience, prices made higher highs and higher lows. Now it just made a higher high. Generally, price tugs back and like after making a higher high. So let's say I think it's going to go down. So I'd enter a sell position. Now, if you're on a $2,000 account, demo or live, just make this, 0.01 lot size. So if it goes up against you, you're not really going to lose much. And if it goes down in a profit, you're not going to make a ton either, but this will allow you to get experience. So one of two things are going to happen. 50% of the time it's going to go against you, and the other 50% of the time it's going to go into profit. We'll cover the profitable outcome here real quick. If it goes into profit, you close it anywhere you think you should close it. It does not matter. Like, I probably wouldn't be trying to hold trades for 1,000 pips, but I also probably wouldn't be closing them in only 5 pips of profit either. You just look at the chart, whatever makes sense to you. If you think that prices might come down and then make a higher low and then go back up, then it might be a good idea to just close price like around maybe the previous high, because it might turn into a break and retest and bounce and go up. If it goes into profit, close it whenever you want. That's what you do if you have a profitable trade. You will learn through experience optimal places to start closing trades in profit as you get more experience. Now, that'll happen 50% of the time. The next outcome that will happen is price goes against you. So if price goes against you, you just add at the next designated area where you think price is likely to reverse at. So for example, you could just use, one of the things I'll sometimes do is use round numbers. Right there's like the 1.5 price level. Where I entered right here, entered quote unquote, is like the 1.485 or 1.49 price level. You can use round numbers if there's nothing else. Sometimes you'll have like a daily or a weekly support resistance zone. Maybe price had like bounced there before, and this was like a big area where price rejected. So you think, okay, maybe it'll bounce there. So I was wrong about this entry here, but maybe it goes up to this next zone. Then I can just add there. So let's say price does in fact go up to that next zone, then you add. And again, just a 0.01 lot size. You don't have to use heavy position sizing at all. You're just trying to learn, get a feel for where price kind of bounces around at. So now from here, one of two things will happen. Gold sticker for you if you thought it would go up or down, because that's what's going to happen. It's probably not going to go sideways forever. It's going to go up or down. If it goes down, you can close in profit anywhere you want. You can close around like your first entry, and then your second entry is the profitable trade. So now you were wrong about it bouncing there, but you were able to profit because you just added at the next zone. And then now all your profit came from the second trade. Some people call that a DCA trade, a recovery trade, a grid trade. You just added to the losing trade. That's it. And you didn't increase the position size. You just used 0.01. So that can work out. Perhaps sometimes you get in a position where both of them go into profit and you're still holding and you hold both of them. Then it becomes a nice big profit. So you start getting excited about drawdown, which is very strange of a trading strategy to get excited about drawdown, but sometimes you do. And the second thing that can happen is that it goes against you again. So you wait till it goes further against you. Perhaps maybe this is like a bigger time frame, huge trend on like the weekly, and it's gone up and it's gone down, it's pulled up. Now it's just gone up and made a higher high here. Now you think it's going to pull back. So you add a third position up here as it just made the higher high. Now there's going to be only two things that happen. It's just going to go up or down, and you just do the same thing over and over again. If it pulls back and comes down, then you can take this here, you can close in profit there. So this one will be in profit, the first one will be at a loss, and then this one, your entry might be like closed around break even. This right here is a break even outcome if you use the same position sizing. And so You're able to get out at break even. Now, again, it could go even further against you, but this is the point of using like small position sizing, like 0.01 lots for every $2,000 in the account, is because even if this happens, like you're using such small position sizing, you're unlikely to blow the account. The only way you're going to blow the account, and again, that will happen at some point, is when price just goes on a huge run of like, 1,000 pips or more just in one direction. It just doesn't pull back, right? Something like pandemic, like COVID going in one direction forever, that will blow your account. But how often is that going to happen? It's just not very often it's going to happen. And if you don't believe me, you go test it out for yourself in the TradingView replay mode. Generally, price flips around back and forth, and you're able to get out at a profit or break even most of the time if you're using small enough position sizing. So this is just kind of a brief framework for kind of how it works. Then what I can do is I can get into the charts here, and I can actually show you some trades that I've actually taken, very, very simple trades here over the past few weeks that I've called out live to people who are in the MFX Nicks Trades group. Before I continue, Cam, anything you want to ask or anything you want me to talk about in specific?
I think this. I mean, it sounds like there's a little bit of a strategy in there, like in terms of break and retest, which I know was something you used to do religiously. Is that something that people, if they were going to put something around this, like outside of their intuition, and a little bit of I'm going to hang my hat on break and retest at least. Is that a good idea for them to do?
Well, I'm not going to say it's a bad idea, but what I will say is that it's just not necessary. And the reason being is because if you don't have the experience to justify that what you're doing is likely to have some sort of efficacy long term and be profitable, there is literally no difference between you drawing a random support resistance zone on the chart that you think is good and saying, I think it's going to bounce here. There's no difference between that versus just flipping a coin. And why is this the case? It's because without the context of experience, you don't really have enough to work off of to say, like, you could draw a support resistance zone anywhere on the chart and say, yeah, price might bounce here. But really, without having the intuition and experience, it's a 50-50 bet, because the price is going to get to that, the zone you drew, and it's either going to bounce or it's going to break. And if you don't have experience to justify the use of like, no, this is a good place to draw it, and this is more than 50% likely to bounce, there's no difference between using that or Fibonacci or moving averages or trend lines and all this other stuff people could use versus just flipping a coin. You can flip a coin, the coin's going to be right like either as often as you are or a higher percentage of the time than you are, because there's maybe not a higher percentage, but you're not going to be right any more than flipping a coin if you don't have experience as a beginner. So I won't say that it's necessarily a horrible thing to like look at the trend and try to see, okay, I'm going to trade with the trend, or I'm going to buy at support, sell at resistance. What I'm saying is that's just not necessary, and it doesn't really contribute any value to a trading approach any more so than literally just flipping a coin. Because at the end of the day, you're just drawing random things on your chart, you calling it a trend line, calling it a support resistance zone. And so you can do that, but I don't think it adds much value. I think it's better just look at a chart and just say, I think it's going to go up, or I think it's going to go down, and then here's how I'm going to control the risk if it goes against me, because that's all that really matters. Everything else is just a narrative you put behind it. So literally, instead of support resistance, I would just flip a coin.
So is it kind of like, and also around taking profits as well? I mean, is it kind of, for you in particular, you wake up in the morning and go, right, where are my trades at? And you have a look and go, okay, these ones are in profit on this pair. These ones are like in drawdown. I'm going to close the ones in profit because I just think that's probably enough profit for me. Or is it a case of something a bit more complex than that?
Yeah, I mean, it's all experience, of course, right? So it's like, I see price has gone to significant profit. We're getting here around a previous, like a weekly low or a daily low. I know some people are going to come and be like, hey, look, you're using support resistance. You're telling us not to. All I'm saying is that the only thing that makes any of that work is experience. And so if I see that a trade has gone to significant profit, and let's say, I don't know, it made like a lower low, right? It's in a downtrend. I sold, then it made a lower low, and now it's likely to maybe have a reversion back upwards. Yeah, it might be a good time to close the sell positions. How would you do this if you're a beginner? You just close it anytime you think that it's, quote, enough profit. The way I generally teach this is I don't give people like, take profit at 100 pips or every time you make $100 on a $10 on a trade or whatever. The way I generally put it is to say, if you're trying to have your profit targets at like 1,000 pips away from the entry price, that's probably unrealistic. You probably shouldn't do that. But if you're also taking profits every 5 to 10 pips of profit, well, that's probably too little. You're probably leaving a lot of money on the table that you could reasonably make. Now, what this leaves is it leaves sort of a range, sort of a threshold of like, okay, 1,000 pips is like trying to be a hero, shooting for too much, but 5 pips is like kind of silly because you're going to have drawdowns that are way bigger than that all the time, and you're only taking 5 pips profit. It doesn't really work from a risk reward scenario. So the key is as a person continues to get experience, they're going to start noticing, okay, if I'm in a trade and it's gone into profit like 200 pips and it's hitting like a weekly resistance zone and it's just made a higher high and like it's starting to paint a bearish candle and all these things are telling me like maybe right here's a good place to take profit, the totality of the circumstances, it's a good winning trade, then you'll start to notice like, okay, yeah, I'm going to take profits here. Okay, cool. But you're only going to know how to do that after you get enough experience. So that's why I tell people just close it whenever you want. You'll see if you close your trade and like 90% of them go into more profit, well, that then teaches you for next week, well, let me just start holding my trades a little bit longer. If you notice that your profit targets are never being hit because they're like 500 pips away, then that teaches you, okay, 500 pips is probably like a ridiculous target. Let me maybe shorten it up a little bit and try to figure out a different way to do this. The only way you get through that is experience. So when it comes to, like you said, your question, how do you select your profit taking? Close the trade whenever you want in profit, and then you approach it through like an iterative way in which you start being able to see what tends to work and what tends to not work. Just do more of what works and less of what doesn't.
Okay, cool. And one last question before we dive back in and have a look at a couple of trades. So what if somebody, listens to this, walks away and goes, okay, great, I'm going to jump on the 1 minute chart and try and do this. Is the 1 minute chart or like these lower timeframes, is it kind of an acceptable approach?
Not for me. And the reason being is just because there's too much volatility. The moves are very big. I'll give you an example. If you were to do this on, say, like GBP JPY on the 1 minute chart, you could be adding like every like 5, 10, 15 pips, right? And then the price very regularly will have big, strong moves in one direction with no clear pullback. If you're looking at the 1 minute chart for like 50, 100 pips or more, it goes in just one direction. The whole reason this approach works, aside from the fact that you just withdraw every time the account reaches a growth target, the reason this works really well, particularly in the Forex market, is because it's a market that I like to call like a steady state market. And all that means is there's just plenty of impulses and then pullbacks. It's not like a crypto altcoin during a bull run, which is up like 2,000%, and then it continues to go up like for weeks. The FX market generally goes really far in one direction, then it has a nice little pullback, and then it goes far in one direction, it has a pullback. It just kind of like bounces around back and forth. So it's born of the idea that this happens and there's pullback somewhere. The problem is if you're using 1 minute, let's say the average impulse on GBP JPY is, I'm just making this up, like let's say 100 pips for simplicity, and then it'll pull back maybe at least 30, 40 pips. Okay, if you can work well with this, then if I'm entering a trade and then I only add if it goes like 100 pips or more against me, then I add there, it's very likely, like a high percentage of the time, there's usually going to be some sort of a reversion, or you can at least just get out and break even. So you could take a trade that was a huge loss and then it ends up just being a break even after everything's said and done. Even if it goes 200, 300 pips against you or more, you can still manage that well. If you're using lower time frames, then a trader might just start adding every like 10, 15 pips, and then you get into that thing where it runs against you 200 pips. It can just blow the account very easily. Mm-hmm. And again, the whole goal here is like, let's just not blow an account. Let's try our best to not blow an account by using small position sizing, and then using that in the context of something that generally works most of the time under the right conditions. That's why I use like higher time frames. Like really, I just look at daily and weekly. I'll glance at the 4 hour a couple times a week, but I think that using lower time frames is not really the best for this type of trading approach.
Yeah, that's good advice. Now, let's dive in and have a look at one of these trades.
I got into a trade right here, which was a sell. Now, why did I get into this sell? The whole reason is just experience and intuition, right? But if I'm putting some framework in place, it just looked like it was a support resistance zone to me. It had bounced here as resistance, bounced here as support, bounced here as resistance, here's resistance, support 2, 3, 4, 5 times. Broke below, came back and touched it. I just thought it might bounce there as resistance. So what I did is I started a trade up here as it got into the resistance zone. I know it's purple, so it's kind of hard to see. I'm going to zoom in just a little bit just for the sake of everyone being able to see. So it was here. When it started to go into profit, I added to this. And that's just because I thought it was a higher quality trade setup. So that's why I added to it. And then whenever it spiked up again deeper into the zone, I added again as it went deeper into the zone up here. And then this, I tried to copy and paste that. So I added again as it went up there. And then as it started going down, I added like 2 more positions. I was in 5, 6, 7, 8 lots on this. I can't remember exactly, but I showed all this in Telegram, and I also showed all my P&L history. So you can just put the link in here for people to join my free Telegram channel if they want. They can see everything there. I've been running that Telegram channel for like 6 years, like since you and I did our first podcast, like in 2018, I started that channel. And so all this is there that everybody can see the specifics if they want. So I entered all these trades. I had like 5 or 6 entries or more. And then whenever it finally had its pull, I don't want to call it a pullback, but when it finally had a move down here, I closed at the previous low, thinking that it just might bounce at these lows. So I just closed it there and got out of it. So this was a nice profitable trade. That was a great trade. Now let's look at a trade that's like not an amazing trade. That's like not going that well right now. This trade right here was a $6,000 profit. So just so you know, like among all the entries and everything, it was $5,700 or something like that. And the swaps were negligent. So holding it for 2 weeks didn't really matter because the swap fees were so tiny because the position sizing was relatively small. So now I'm in a trade right now on the same pair. Price came back here into the zone. I started a sell position. When it broke above this zone, I added more positions around this price right here. People can go into Telegram to see my exact trades. I show my terminal in there. And then now what I'm doing is I have an alert up here because I'm wanting to add at this zone right here that I've already got highlighted on the chart. So I'm going to be adding again if price gets up here. And then currently these trades are in on USD CAD. It's in about a $5,000 drawdown on these entries. Now again, how often does USD CAD go in one direction with no pullback? Like this right here is a 360 pip move. The last big move is it went for 500 pips with no pullback. Then it finally had a reversion upwards. This one here, it had a huge move to the upside, like 330 pips. And then it had a big move back. This down here, it had a big move down here, 300 pips, then it pulled back. Another huge move here, like probably 500 pips. This is 400 pips, then it had to pull back. Most of the time, USD CAD does not go a couple hundred pips without pulling back. And so as long as you're not sizing too big, then you're able to usually come out on top in most cases in a net profit. So the account that I have right now, it has like, I think it's like 195K balance. Or maybe a little bit more, but it's in like a $5,000 drawdown on this trade right here because it's sitting in drawdown. Now, if the price goes a little bit further, I'm able to add up here around whatever price this is, and then it does have a pullback. It just has to get somewhere like around here, and then I'm break even. But then if I hold it all the way down to the zone again, where it might bounce, just because price kind of like bounces around these zones. If I hold it all the way to there, then I can close my initial entries at break even. So I was super wrong about them, right? Multiple times, and I can still get out of that break even. Then that trade will be a profit right there. I'm going to zoom in so you can see. And then these basket of trades up here, if I'm able to add to it, will be a net profit. And guess what? If it keeps going against me and goes all the way up here, then it'll be, I don't know, like an $8,000 to $10,000 drawdown. And then I'll add again at the weekly highs. And then if it has a pullback, I'll try to get out around break even. And then if it goes and makes a higher high, I'll add up there. And that might be $15,000 to $20,000 drawdown. But again, an important thing to consider is like just last month alone, I've made $30,000. So this is like a worst case imaginable scenario. And it still wouldn't really be that big of a deal if it just kept going into drawdown because the sizing's so small. A $20,000 drawdown on a $200,000 account, in my opinion, if you've kissed the 200K goodbye, that's just what I'm trading with in that account. I'm comfortable with that account blowing if it does blow, as much as I would like that to not happen. I'm comfortable losing it. If it blows, it's not that big of a deal. If I'm comfortable losing the 200K account every now and then, knowing that I'm only in a 20K drawdown, that's like 10% of the account. It's just not that big of a deal. Plus, I know that most of the time it's going to have a reversion that gets me out in profit. So after this podcast comes out, people can go and look back on the charts. We're here on October 14th, 2024. People can go and see what ends up happening over the next few weeks, and they can see what ended up happening.
Yeah, for sure. Look, we'll hook a link up under this video here on the podcast description to Nick's show, so you can go and find his Telegram in there, and you'll probably be able to see exactly what happened on this trade, or check out the charts if you want. Now, Nick, hey, mate, that's been absolutely fantastic having you back on. I'm sure it has enlightened quite a few of the listeners out here. So what's the best way for them to find out more from you?
I just tell everyone to just go to my YouTube channel. I teach everything I know there for free. My name's Nick Shawn. Just make sure it's the YouTube channel with the little tick mark because there's like hundreds of fake accounts of me. Don't try to message me or DM me anywhere because it's probably a fake account to begin with. And then on top of that, I probably just won't even respond because like there's too many messages. But I teach everything for free on my YouTube, literally everything. And then on top of my YouTube, in the link in the description of all the videos, I have the link to my Telegram channel. It's just free. There's like right now, there's over 60,000 members in there. You can follow all my analysis for free every day. So I give like 90% out for free, where I teach my whole trading approach on YouTube, and then I show it live with the analysis in Telegram. And then if the only thing I charge for right now is just my personal trades, and it's a $250 per month subscription right now, where if you just want to see the exact trades I'm taking, following my trading approach that I teach for free on my YouTube channel, and following the analysis that I put for free in Telegram, if you just want to see the exact trades, that's the only thing I charge for. But everything else, people can learn like all of it for free because I just teach it all for free on my YouTube. So my YouTube channel will be the best place for people to find me.
Well, look, there you go, folks. See, you know what to do next. So head down below. We'll put a link to his YouTube channel as well in that link in the description. So, Nick, thanks once again for coming on. And everyone, I know you've enjoyed this epic episode here, and it's given you a lot to think about. There's more coming up here on Trading Nut, so stay tuned, and we'll see you in the next one.